Hi, my name is Adam Bergman. I'm a partner with the IRA Financial Group, president of the IRA Financial Trust Company. Today I want to discuss unrelated debt finance income, or UDFI. Unrelated debt finance income, a lot of people just call it unrelated business taxable income, or UBTI. It's pretty much the same thing. It's found under 514 in the tax code. UDFI triggers UBTI, so I kind of put them in the same family. Unrelated debt finance income really just talks about the financing involved on a real estate acquisition involving either a charity or an IRA or a 401k. So when you talk about triggering UBIT or unrelated business taxable income because of an investment in an active business, you'll fall under unrelated business taxable income. But when you talk about using leverage, a non-recourse loan to buy real estate, using a retirement account, you'll fall under unrelated debt finance income. Either way, they're triggering the UBIT tax, which essentially follows the trust income tax rates. They're all reported on 990T as in Thomas as a tax return if you have over $1,000 of UBIT in a year. And it basically, again, covers the use of leverage, real estate acquisition indebtedness to buy real estate. Interesting enough, under 514C9, there's an exemption for 401ks from this UDFI, unrelated debt finance income, using a loan to buy real estate. So it's another advantage of a solo 401k, and you should definitely check out my videos on the solo 401k. But the UDFI exemption under 514C9 is a big winner for the 401k, especially if you're a real estate person wanting to use your 401k to do real estate. It's a great exemption because you can leverage up your investment and not have to pay this UBIT tax, which can go up to 40%, 39.6%, follows the trust income tax rates for as low as $20,000 or so of net income after pro rata exemptions like depreciation or loan payment deductions. If your net income associated with the leverage is over 20 or so thousand, you can hit the highest tax bracket, trust income tax rates of 39.6%. So it's quite high. It changes deals up. I can't tell you how many clients I talk to. Once I mention UDFI and UBIT on the leverage on the real estate, it kills their deal. A lot of times they walk away. Sometimes they deal with personal money. In some cases, they'll live with it if it's a really great deal, or even maybe move to a C corp in order to avoid the UBIT as a blocker. But it's very important to understand. It's one reason to work with tax professionals. The IRA Financial Trust, our trained attorneys and CPAs will help you navigate these rules. It's vital that you understand them because it could change the dynamics of a deal and really make you go in a different direction than using retirement accounts. So please beware of them. How do you calculate this? Well, obviously the 990T is a return, so you'd have to obviously navigate that, and we have CPAs that can help you with that. But essentially how it works is you take the cash you put in and the debt. So let's say it's $50,000 cash, 50% debt. You have a debt to equity ratio of 50-50, and let's say you generate $20,000 of net income after depreciation or deductions. 50% of that, which equals the debt portion, or $10,000 in the example, would be subject to the UBIT tax. As long as that's over $1,000, that'd be subject to tax. And the tax rate, as I mentioned, can go up to 39.6%. So it's quite a hefty tax. It's a huge tax, and it changes things up for a lot of people. So you need to be aware of it. The exemption under 514C9 for 401ks are huge. It's turned a lot of my clients somehow into the solo 401k world and tried to make themselves eligible, if possible, as someone who's self-employed, in order really to take advantage of the high contributions on the 401k, but also the exemption from the UDFI. I can't tell you why it only applies the exemption at least to 401ks and not IRAs. Legislative history just seems to suggest that it was more, Congress felt that they wanted to give 401k trustees more of an investment option, I would say, than IRAs. I'm not 100% sure, but whatever it is, it's in the code under C9, 514, and it's a big exemption. So if you're using real estate and an IRA and you're short and you're going to use leverage, you need, number one, it's got to be a non-recourse loan, because as you know from our prohibited transaction videos, using a loan you personally guarantee will trigger a prohibited transaction or 4975C. So a loan has to be non-recourse. And number two, you have to be aware of the UDFI tax rates, almost 40%. How hard are these loans? They're somewhat more difficult. Before '08, they weren't that hard. After '08, they're more difficult. You're going to pay more points. Generally, they want 35 to 40% down. There's quite a few non-recourse lenders that we have relationships with that we can provide you information on. You can try a local bank, but you got to make sure they understand it has to be a non-recourse loan. It's not something that you're trying to get around or making the banker's life more difficult, just the way the tax code makes you do it. So it's got to be non-recourse. And number two, you got to be aware of the tax. So you got to run the numbers, see how much tax net income you'll potentially have, how high your deductions will be, whether they'll eat those tax up in the beginning years. Also, if the loan is outstanding within 12 months of the sale, the UDFI will apply into the capital gain transaction. So if that loan isn't fully paid off prior to 12 months before sale, even though it's a capital gain transaction, that debt's still considered debt. It's still there, even though it was removed 12 months prior. It's going to be subject to unrelated business taxable income triggered by the UDFI. Tax is almost 39.6. So call us. We'd love to chat with you about this. Really important to work with tax professionals. 800-472-0646. Adam B, A-D-A-M, B as in Bergman, Adam B at IRA Financial Group. Thanks for listening and watching, and until next time.